This is probably a good time, therefore, to talk about deviations. Deviations are absolutely critical to the policy framework. What are these deviations? So, as I mentioned earlier, you cannot deviate as far as the regulatory requirements are concerned. But from a risk perspective, from your organization perspective, you can make some deviations. But those deviations also have to be in a structured manner which are built into the policy. So for example, if you want to give a higher loan than what the policy says, you might need to go to your immediate senior or to a zonal head or a regional head or somebody at the head office, depending on what is the extent of the deviation you want. Another example might be a deviation on the credit score. If the score is very low but you still feel that there is a good case to give credit, you might have to take a deviation approval from an appropriate authority. Now this is where the organization's policy and risk appetite comes into play. Who can make these deviations? Under which situations or circumstances can you make deviations? And if at all you can or cannot make deviations, in fact, all is defined in this credit policy. Just as a kind of a pause here, please remember that the credit policy is something that is not a document that is prepared statically and left to the world. It's not a policy document that is just put out blindly and prepared overnight. It's a document that brings a lot of thought, brings the regulations and is dynamic, and therefore the underwriting team or the credit risk team that writes this policy is looking at all of these in order to enable you as the front person who's deciding on the loan amount, or if you are a salesperson who is looking at a customer and deciding whether he will fall into the policies of the organization and therefore is it worth pushing the loan application into the organization's login system, is something that has put a lot of thought, a lot of brain and a lot of dynamic work behind the creation of this policy. Now we are going to move on to what is the next step of doing the appraisal. Having done the personal discussion and having done all the checks in terms of the bureau score and the KYC and all, you then are putting together the figures, the amount of loan you want to give and the terms. That is a process, but that process again has to be defined, and that is the policy of determining the loan eligibility. So having done all this, we now come to probably what is the heart or the core of the credit policy, determining the amount of credit. So the first thing you do is put the numbers together. What is those numbers? What are these numbers? These numbers are the salary, the balance sheet, the P&L, the assets, the other liabilities, the credit score. All that has to be put together and viewed by the credit officer to determine the loan amount. That's the easy part. But what should the credit officer do when he sees a particular salary, or he sees a particular trend in the income, or he sees a particular loan that the person has taken, or he sees that the credit bureau score is low or high? What he should do and how he should interpret that within the flexibility of his deviations is what the credit policy must be clear. I'm sure you're now sensing that the credit policy has to be clear, because having an ambiguous or a fuzzy credit policy is worse than having no policy at all, because then people will have to interpret it differently. So a credit policy is something that has to be very, very specific and clear. I personally have written credit policies, and I do remember that the maximum effort goes in making sure that the person who is applying the credit policy and reading the credit policy is someone who will have no doubt in his mind what he or she needs to do. That we have all the income details, we have all the financial details, and you have now decided that yes, Mr. X and his wife or Mr. X and his son need to be given a loan, or the loan needs to be rejected. Again, here please remember, the rejection of a loan is also governed by certain policies. It's not random, it's not subjective, and it's not dependent upon the whims and fancies of anyone, because that spells chaos, right? So for example, if the credit score is very, very low, say it's 400, maybe the policy will clearly say if the score is below, say 500 for example, and therefore is 400, reject the loan no matter what. Now, some lending institutions might have that policy. Some might say, even if it is 400, examine it, and if you have a case, let's talk about it. That talk about it is the deviation matrix that I'm referring to. For example, a person who comes to you for a loan has no formal source of income. He doesn't have a balance sheet, he doesn't have a tax return, he doesn't have a salary certificate. The policy must say, what do you do with such cases? Now, some lending institutions might say, we don't give a loan to them. That's a policy. Even the decision not to give a loan to certain segments of society is a policy. Whereas if you go down the scale to, say, the smaller and the micro housing finance companies, their entire credit policy will depend upon how they should appraise people who don't have formal income, because remember, that's their target segment. Now you bring in a word which is very popular and yet often misunderstood, which is surrogates. Surrogates essentially means that if you can't appraise an individual's income on the normal salary certificate, balance sheet, P&L, tax returns, bank statements, what are the substitute methods, the surrogates that you can apply? Examples, a personal visit. Example, analyzing the bank statement. Example, looking at his cash flows in his bank statement. These are examples, and different lending institutions have developed a set of surrogates. Of course, there are a finite number of surrogates. Now, that itself has to be a policy. What to do, which ones can you apply, and what consequence or conclusion can you reach based upon such analysis. You're not being as objective as you would if you looked at somebody who's got a salary certificate or a tax return. You are now taking a judgment call. And that judgment call also must be defined, or the rules under which you take the judgment call must come into the credit policy. Once all this is done, you prepare what is called a Credit Approval Memo. Now, the Credit Approval Memo is a memo seeking approval for credit. And therefore, it's called a Credit Approval Memo. Simple as that, right? But that content of that Credit Approval Memo, what it should contain, is again in the policy and is probably defined by a predefined form which individuals, employees of companies from different locations use to summarize whatever is the final recommendation. Approve, reject, give, don't give, whatever it might be.